We've got another very busy week ahead, with the budget on Wednesday the 8th, a European Central Bank interest rate decision on Thursday the 9th, and the latest US monthly non-farm payrolls number on Friday the 10th, all likely setting the tone. On the company front, we've got 9 FTSE 100 firms set to report in the next few days, including equipment rental expert Ashtead and bookie Paddy Power Betfair on the 7th, life insurer Legal & General on the 8th, and more insurance on the 9th, with Aviva and Old Mutual releasing their full year results. But for me, the name really capable of causing a big fuss next week is grocery giant Morrisons, which will publish full year numbers on Thursday the 9th of March. Morrisons shares have staged a recovery since Chief Executive David Potts replaced Dalton Phillips in March 2015, as we can see here, and the full year 2016 numbers, well, they'll be the next test of the company's turnaround plan. Potts and team have already got 2017 off to a good start with an upbeat trading statement back in January. The chief executive announced no fewer than 3 crowd pleasers all in one go. First, a 2.9% increase in like-for-like sales, excluding fuel and VAT, the company's best performance in 7 years, as Potts put it, and that was for the first 9 weeks of the fourth quarter. Second, the Bradford headquartered company added that underlying pre-tax profit for its whole financial year would exceed market expectations to reach between £330 and £340 million, enough for the first increase in profit since 2011. And third, that net debt had dropped to around £1.2 billion, down from £1.7 billion the year before. They're the big numbers to watch for 2016 and also for the year ahead, should the company give any guidance. The consensus forecasts for 2017, according to the company's own website, are for like-for-like sales growth of 1.6%, underlying pre-tax income of £366 million, and a dividend of 5.89p a share, compared to the 5.37 expected for 2016. If, and it's always an if, those dividend forecasts are correct, by the way, they'd represent welcome increases after the dramatic cut of 2015. All of those consensus forecasts, which may or again may not prove accurate, put Morrisons shares in a forward price earnings ratio of around 21 with a yield of 2.4%, a premium and a discount to the wider UK stock market. Now, clearly the strong share price gains are based on the view that earnings and dividends will recover and therefore the PE will drop and the yield will rise, assuming an unchanged share price. Value investors, however, will be intrigued to see that the company's market cap and net debt together come to £7.1 billion, while tangible fixed assets on the balance sheet also come to £7.1 billion. So on an asset basis, the stock may not be expensive, so long as there are no further write-downs of the balance sheet value of the stores and sites, and if there are any increases, stock may be cheap. One final thing to note will be any comment from Morrisons about the impact of the weak pound and whether it will affect prices and margins. We have, after all, already seen rival Tesco come to blows with Unilever over product price increases in the so-called Marmite Gate affair. Thank you for watching, and I look forward to seeing you next time.